Hello and welcome to another video on my YouTube channel. My name is Joris and today I'm here with a video about the biggest UCITS ETF investing its money towards the US economy, and I'm going to compare that one towards the two cheapest ETFs that you can buy on the European continent, and they have a total expense ratio of 0.03%. So the biggest one has a total expense ratio of 0.07%. So not that much of a difference, but it's less than half of the cost of the biggest one. And of course, you have way more expensive ETFs as well, investing towards the US. So, I already said it in the previous two videos on my YouTube channel, why I am comparing the biggest ETF compared to the cheapest ones. Because I'm annoyed when I read that an ETF should have at least, most of the time they say 100 million invested into it in order to be considerable for investing your money towards. So all those kind of experts or self-proclaimed experts, they say that an ETF should have at least 100 million invested towards it. But what with new ETFs that just start and have 30 million invested into it or 50 million, but they follow more or less the same index as the one that you are investing towards now, and they are way cheaper. So for me, I believe that you should switch and start investing from that moment on into the new cheaper one. And hopefully then the old ETF, the provider, sees that all the money is flowing towards another one and they lower their total expense ratio themselves as well. Unfortunately, a lot of people start to invest in one ETF and they never change to a cheaper option because they aren't looking anymore towards cheaper options around, and they don't bother. And I say change because I'm not saying to sell all your previous ETFs and buy into the new one, because that comes along with a lot of costs as well. So you have to consider that if you are considering that option. But what I'm saying is, from the moment that you know about the cheaper option that is doing more or less the same as your old one, and it's way cheaper, just stop investing towards that old one and change your order towards the new cheaper ETF. Of course, you can have scale effects for an ETF that is way bigger. So when there is much more money flowing towards the market, when the market is going down, that is going to influence the performance of that ETF in a positive way. But it can be the other way around as well. So when there are a lot of people invested into that ETF and they are older and they start withdrawing money from the ETF, especially when the market is going down, this can have a negative impact then on the ETF performance. So you can have it both ways, going both ways, but it's always important to do your own research. So for me, it's not financial advice that I'm giving, it's just entertainment, why I'm making these kind of videos, and for informing you about the different options that you have. So you have a lot of UCITS ETF investing toward the US, and the cheapest options are in fact ETFs that invest towards the US, and there is also a lot of demand for them. So and I hope in the meantime it's also you, want lower fees for ETFs investing towards other regions as well, so globally or especially here in Europe for Europe or the European continent. And if you talk about US indexes, in the first place you think about the S&P 500, you have also the Nasdaq 100, you have the Russell 2000. So they are really popular with investors. And this is totally okay. I understand it. I also invest towards the Global X S&P 500 Cover Call ETF. So it's just a great index with great companies in it. But when you invest towards a global fund and you see 60 to 70% of those funds flowing towards US stocks, I believe that that's not ideal for a portfolio here in Europe, because the US economy is actually only around 25 to 27% of the world economy. So when you look at our ETF portfolio, so my wife and my ETF portfolio, the US makes up 30.14% of our portfolio, and Europe makes up 32.43%. So it's 31.58 is developed Europe, and we also have 0.85% towards the emerging countries in Europe. And these numbers come from GetQueen. I believe it's a really good app. I'm not sponsored by them at all, but I use GetQueen sometimes as well for showing things here on my YouTube channel. And one of the great things on GetQueen is that you get a geographical distribution of your portfolio. And then, yeah, ExtraETF, I always use it for these kind of videos as well. It's a very good website. Sometimes their numbers are a bit strange. Sometimes their total expense ratio isn't completely correct, but it's always for less known ETFs, so don't worry about the really good ones and the bigger ones. So it's only the newer ETFs that sometimes there is something strange about it. And also the totals sometimes are not matching up. I will show you that in a minute. So let's have a look for the US dividend ETFs. So let's change to the ExtraETF website. So it's for Switzerland here. You go to search ETF search, and then you see all products 3,290, and that's what I mean. The numbers don't always match up, so you only have 3,269 search results. So where are the other 21? I don't know, but it's just the way it is. And you always have here an ad ETF that is especially showcased. So don't look at that one, just look at the one below and go from there. So we are going to look at the region North America. Then we are going to see for dividend paying ETFs, so 133. And then you know that I don't like synthetical ETFs, so I'm going to go for the physical ones, and we have 100 left. If you don't put that on, so you have 125, and here you see it's 133, so that's what I mean. Numbers don't always match up, but it's also so, like the SPY5 ETF that I'm going to discuss today on the Swiss 6 stock market, you have two options to buy it, so I think it's because of that. And here you can see immediately you have when I look at the total volume, the biggest ETF is the Vanguard S&P 500 UCITS ETF with almost 38 billion invested towards it. So it's a really big market, the US stock market, especially for ETFs, a lot of money flowing towards it. The iShares Core S&P 500 UCITS ETF is the next one. So S&P really popular. And even the third one, and it's one of them that I'm going to discuss today in my video, it's the State Street Spider S&P 500 UCITS ETF with already 12.4 billion invested towards it. And I believe this should be higher and higher because it's, yeah, more than half cheaper than the ones from Vanguard and iShares. So they are performing exactly the same because they are following exactly the same index, S&P 500. So there is nothing stopping you from investing towards the cheaper option. And by doing so, you also give pressure to Vanguard and iShares to lower their fees. And we can look at the total expense ratio as well. So here you can see First Trust 0.75%. I'm not talking about this one because it's Beta Builders US equity. That's a really stupid ETF. So don't look at that one at all. Then you have three of First Trust, which are way too expensive as well. They are even 0.15 up to 0.25% more expensive than the first one from Invesco. So 0.50% for me, that's still okay, because especially for emerging countries, there the total expense ratios are even more expensive. But yeah, don't go for these ones. Go for the cheaper options. And here you can see the cheapest options: Amundi MSCI USA UCITS ETF and the Spider S&P 500 UCITS ETF. So both 0.03%. The Amundi one you can't buy on the SIX stock exchange. Hopefully not yet. So I hope it comes available in the future, because that's one that I would advise my kids to buy then, from the moment that they earn money and they can start investing towards ETFs. They should start investing towards the Amundi one. It's a very good option, and there is just slightly more than 100 million invested towards it. So in that regard, it now comes available, according to a lot of experts, to put your money towards. But when it was 89 million, they would say, hey, no, it's too small. When in fact it's a really good ETF. So let's get back to the presentation. So we have the biggest ETF being an S&P 500 ETF from Vanguard, the VUSA, and we also have the Amundi MSCI US UCITS ETF, and that's the WEBI, and the Spider S&P 500 UCITS ETF, that's the SPY 5, but you will see in a few minutes. And as I showed you, you have also really expensive ETFs, so you should certainly neglect those. So you even have mutual funds from the banks that go up to 3% in cost. So always watch at the total expense ratio of the funds and go for the cheapest options that you can find, if they are performing okay. So we can go to the VUSA, so the S&P 500 index. They track the 500 largest US stocks. You always have the easing code and the total expense ratio. So you can buy one share for 94.28 Swiss francs. The dividend is being paid out in US dollars. There are 503 holdings into this ETF, and there is 37.264 million invested into this ETF. Fully replicated type, and it's been around since the 22nd of May of 2012. So it's important this date that you remember that one compared to the next one. And in the past year, it is up 13.13%. In Swiss francs, it's 5.05%. So it's always US dollar here and Swiss francs here. It pays out 4 dividends per year, so quarterly in the most common months for paying out quarterly dividends. And the dividend yield is 1.04%. And as US stocks are most of the time paying quarterly dividends, you see that the payments of this ETF are also really evenly distributed over the quarters. So in that regard, US ETFs are better than European ETFs, where you always have a peak around June. And then you have the SPY 5 from State Street, the Spider S&P 500 UCITS ETF, with a total expense ratio of only 0.05%. And you have the possibility to invest in it in US dollar on the SIX stock exchange as well. So now you can buy one share for 497.75 Swiss francs, but you can buy one for US dollar as well. I will put the link to the video that I made about the US dollar option for the SPY 5 ETF in the description down below. And the dividend is being paid out in US dollar, and that is great, because then you can accumulate your US dollars to buy another share of the SPY 5 ETF. Unfortunately, it costs a lot of money, so it's not a cheap option to buy. It's relatively, it's okay, of course, but gathering 500 Swiss francs to buy one share, it's always a bit annoying. So it would be better to have cheaper option from Spider, but it's the way it is. So 503 companies in this ETF as well, 12.384 million invested towards it. And here you can see 1 year performance 13.17%, so a little bit higher. Over the past 5 years, it is performing a little bit less, but the past year it is performing a little bit better. And it pays out quarterly dividends as well in the same months, and the dividend yield is 1.07%. So almost the same, 1.04 compared to 1.07. That's not a huge difference. And they pay out more or less 1 week, 2 weeks later their dividends than the one from Vanguard. And once again, nicely distributed over the quarters. And then you have the one from Amundi, so one of the cheapest ETFs around as well. So 0.03% total expense ratio. That one invests towards the MSCI USA index, and that one is tracking the leading stocks on the US market. So the S&P 500 is investing towards the 500 leading stocks on the US market. This one doesn't say it's capped at 500. That's the only big difference in fact. This one is available on the Xetra for 40.56 euro per share, and the dividend is also being paid out in euro. You have 588 holdings into this ETF. So for me, I believe that's better, bigger diversification. And there is 190 million Swiss francs invested toward this fully replicated type. It's been around since the 5th of March of 2024, but there are numbers for 3 years and 5 years as well as a performance. But in the past year, it is up 13.68% in US dollar. So it's the best performing over the past year. But for the past 5 years, it's underperforming the other two. So why that is, I don't know. But in the recent history, it's really performing really good. And Amundi only pays out one dividend per year most of the time, and this time it is in February once again. The dividend yield is 0.95%, and it's 0.39 euros that was paid out on the 12th of February of this year. And if you look at the top 10 holdings, you see that it's more or less the same. So you have Apple, Nvidia, Microsoft, Amazon, Meta, Alphabet. Here you have Berkshire. You don't have Berkshire in WEBI in the first 10, so it comes out later in the top 20. It's available, but not in the top 10. But then you have Broadcom, you have Alphabet, and you have JP Morgan Chase instead of Tesla, because Tesla is here a little bit higher. But little differences. Even the weight of the top 10 holdings is more or less the same. If you look at the distribution of the countries, because it's an S&P 500 or MSCI USA based index, a lot of it is going towards the United States, of course. So almost 96% is going towards the SPI 5 towards United States, and for the WEBI one, it's 95.17%. So you have a little bit in Ireland, and then you have the rest. And if you look at the sectors, the only difference that you can see is the financial and the consumer discretionary. Those swapped places for the SPY 5 compared to the WEBI 1. So there you have a slight difference, but for the rest you see technology, healthcare, telecommunication, industrial, consumer staples, energy, and utilities is almost completely the same. And if you look at the performance, because this one started in 2012, it's up 411% since its inception, and you see it's nicely in the green. Here you have the COVID pandemic, then here you have the difficult year of 2022, and here in October it reached its bottom, and since then it's actually rising again. In the same in 2023 in October it dipped down, and yeah, now here with the tariffs of Trump we had a dip as well, but now the S&P 500 is again at all-time highs, so nothing to worry about. All the time the markets are recovering from downtrends. And WEBI, so WEBI, it says it started in March of 2024, but you have a graph from 2019, and you can see here COVID dipped below the 0% line, so then it was in the red. But for the rest, it's only up in the green. And if you compare both to each other, you see that the Amundi one is up 128.16%, and the Spider one is up 140.24%. So not that big of a difference. And in the past year, actually, the Amundi one is outperforming the SPY 5 one. So the conclusions, if you look at the S&P 500, the Vanguard fund is the largest, but the Spider one should receive all the money in the future. That's my belief, because they are way cheaper. And the crazy thing is, Vanguard with John Bogle or Jack Bogle, it's a lot of people named him Jack Bogle, but all these books are from John Bogle. So when you read a book by Jack Bogle, always go and look for a book written by John Bogle. And one of the best books that he wrote was the little book of Common Sense Investing. That's a really great book. It reads like a train. So go and check that book out for sure. And yeah, he was all about low fees, but then you see that even though the fund started 3 months after the fund from State Street, that their fees are higher than the one from State Street. So why are they doing that? Yeah, earning on 37 billion, 0.07% every year. That's of course way better than only earning 0.03% on it. But I believe that State Street is doing the right thing. By lowering their fee, they are attracting more money, or should be attracting more money. And hopefully over time they will have more than the money put towards the Vanguard fund, and then they will earn a lot of money as well, because 0.03% of 14 billion, that's also not, yeah, when you give that to me at the end of this month, I will stop working. But paying around 500 Swiss francs for one share is of course not very handy, especially for starting investors. So my tip to State Street would be to do a stock split of the SPY 5 ETF and bring the price of the ETF down to at least 50 Swiss francs, even better 25 Swiss francs. And that would mean that in US dollar it's 60 or 30 US dollars. And in that way, you have younger investors that can only put aside 100 Swiss francs every month. Then they would be able to buy 2 shares of their fund. And now, yeah, they have to save up for 5 6 months, and then they can buy only one share. Sometimes they can buy fractional shares with their broker, but that's not always the case. So for me, it would be great if they would consider doing a stock split. And Amundi once again offers a nice alternative with nice performance, especially in the past year. But it's not on the six yet, and they only pay out one dividend per year, and you know how I feel about that. I like quarterly paying dividend ETFs and stocks, and it's just started. So officially it started in March of 2024. I believe that you also have an accumulating version of the WEBI ETF, and that one started in 2019. So I believe that they just made a split of those kind of ETFs, and that you still have the accumulating version, and that the dividend version, the distributing one, split off from that one. And the first dividend was actually paid out on the 12th of February this month. So before, you didn't have a dividend at all. So it's truly, the distributing type only started in March of 2024, but you have the performance going back to 2019. And as always, do your own due diligence and decide wisely in which ETF you want to put your money. If you want to put it towards European continent, towards the US, towards global funds that only invest in developed countries or in developed and emerging countries, it's up to you. So make your decision. If you are working with satellite core strategy as well, you have to do your homework. And with that being said, I thank you for watching to this one. Please consider excuse me for that. So please consider subscribing to my YouTube channel. It would mean a lot to me to see my subscription number going up, and also hitting that like button helps out the channel enormously. So thank you for that, and see you on the next one on my YouTube channel. Bye.